Do you ever stare at a chart for hours and then step away for 5 minutes and all of a sudden, the setup which you've been waiting for emerges and you're nowhere to be found? You're not alone. Most traders miss A-plus setups, not because they don't exist, but because they can't recognize them in real time. In this video, I'll show you the setup that most traders miss, why they miss it, and how to train your brain not to miss a setup like this again. It's not about not knowing the setup, it's about not being prepared to act when it actually shows up. Now, there are a lot of things that can make traders miss their setups, be it their A-plus setups or their A setups or their B setups. And there are a bunch of them out there based on psychology and all. But the one thing that I know that makes a lot of traders miss out on their trades is what? When they overtrade. And I'm going to share a bit more about this in the later part of the video. Most traders operate reactively. They chase rather than anticipate. The brain isn't trained to see the familiar in the unfamiliar. It's kind of a pattern recognition problem. So let's take a look at this setup. Now, this is a blank chart. Price moves from zone to zone. So I'm just going to draw a zone right here and I'm clone it. Let's say we got these two zones and you know the normal movement of price in the market. Price moves from zone to zone. So price hits this zone, comes back until it actually gets to touch this zone, and all of a sudden it bounces back to go back to the same zone if we're in a ranging market. So typically this is how price moves. Price moves from one zone to the other. Now, you've got a strategy as a trader. Maybe in your A-plus setup, your A-plus setup is a break and retest. Now, in that A-plus setup, let's say that you've got a sub setup. These are kind of the things that make up your criteria, your entry criteria, or your rules of engagement, as the case may be. You've got as a sub setup inside your A-plus setup that whilst price is trying to break and retest the zone, you only enter once it has actually flagged. You don't take the bounce off. Why some traders will want to take the bounce off? You prefer the flagging, and that's your own preferred style of trading. That's fine, and that's cool. So in this case, let's say that in order for price to move from zone A, which is this one here, which is this zone here, to this zone here, you actually want to wait for price to break it like so, come back to that zone. But in coming back, let it flag. So this is the characteristic flag pattern. Let it flag like so and get back to this zone and then break. And once it's about breaking, that's when you can take the trades to the downside. Now, this is pretty much a simple and clear setup. Why is it that it makes it difficult? Sometimes it's difficult to get on this trade. Why? I'm going to show you why in this video. So, for example, let's say that you have got your risk rewards tool like here. You're waiting for a bounce off like so, upon which you place your stop loss above the zone and then you'll take profit on the next zone. This is a healthy trade, almost a 1:5. This is about a 1:4 and risk to reward ratio, which is nice and cool. Now you're waiting for it to flag and then you've got a counter trend line like so, and waiting for price to break this counter trend line so you can get into the trade and then take it all the way down to the next zone or whatever your target may be. Pretty easy, right? But some traders actually miss out on this trade because the thing is, price has a theoretical basis, but when you come to the actual market dynamics tend to confuse a lot of traders because price is not going to always present the way it's being seen in textbooks, the way it's being seen in schools, the way it's being, put in books and a lot of that. Even when you do back tests, the patterns you've seen during your back test doesn't guarantee a repetition of that in future trades. So price is purely dynamic and it only takes a flexible and adaptive trader to be able to catch price based on their plan or their trading plan as whole, or based on their trading age. So this is pretty straightforward that a break and retest of a major zone with a break of the counter trend line will lead to a trade entry like this. But you still find that some traders are going to miss this kind of trade. Why? I will show you a pretty much good example of this now. Now, this is an actual chart on the currency pair NZD CAD, and this pretty much is very similar to the other annotation I was given. Now we've got, you as a trader has come now and we've got to see that this is a zone. So this green highlighted area is a zone, and then this is a zone. Price typically moves from one zone to the other, like you can see. I'll just quickly show this now. Price was here. You can see that price, in order for price to move from here to here, price had to break this zone, retest it right here, and then moved all the way down here. And that's how price actually moves in the market. Now, that iconic strategy I talked about, which is a break and retest, this actually played out in this chart. Now, this is actually a trade I took on NZD card, and in order to take this trade, I had to wait for price to break like so. You can see that price broke pretty nicely. Broke. Now, this is the break. Now, this is the retest. Now, this is the retest right here. Price has come back to retest the zone. And then, whilst price was about moving, I was able to hop on this trade. And I took the trade. Now, where is the flagging? This is the flagging. Without wasting so much time, I'll show you. This is the flagging of this trade. So this is the flagging and the break and retest as occurred. And I was able to capitalize on this trade by, after a break of the flag, which was the counter trend line, I placed my stop loss just above the zone right here and placed my TP at here. So this gives me almost a risk reward of 1:2. This is about 1:1.7. Easy, right? But I'll show you one of the reasons, or most of the reasons why traders miss this. So the first reason why a trader can miss this setup is, one, they expect price to play out in a theory fashion. So a break and retest typically might mean, okay, price has broken below this zone, price should hold on to this zone before it comes down. But you can see it didn't happen in this case. Price actually broke this major zone, came and broke this minor zone. Okay, just to point out now, this zone in particular, the one in orange, this particular zone is a minor zone, but it's also an important zone to note. So once you know that these ones are your major zones, this one is a major zone and this one is a major zone, this one is a minor zone. And before I took this trade, I had to make sure that price not only breaks and retests the major zone, it also needs to break that minor zone, because that minor zone is going to pose a lot of problems if I don't pay close attention to it. So what I did was I had to wait for price to break below it, like so. So after my flagging happened like so, you can see right here, that there was an actual break. You can see right here that there was an actual break of not only my flag, but also the minor zone that was sort of contentious. And this gave me the courage, this gave me the confidence to take this trade. And I put my stop loss right above there. And then my take profit here. So this was how I was able to swiftly gain and profit from this trade. But a lot of traders will not take this trade because, first and foremost, they will wait for price to hold here, like I told you. Once price don't hold here, you will see them, they'll be like, okay, it looks like price now wants to be bullish because price has now broken this zone right here. You will now see them flipping their bias immediately and wanting to take buy trades on this one. You will now see them taking buy trades, and before you know it, the market goes in their favor a little bit and stops all of them out and reverses back like you've seen here. So first and foremost is they don't have a strong bias. The next one is that they are very given to over trading. Now, once you are waiting for a break and retest towards the downside, and you'll see that price has now broken above a minor zone. A minor zone might not be something that is strong enough to make you change your bias mid-term. It's not. So if you know your, I just talk like the popular saying, if you know your onions, you know how to actually go about your trades. So when I saw this, I was like, why will you be changing your bias immediately for a trend that is clearly, if you can look here, a trend that is clearly a downtrend? Why would you want to change your bias to start taking buy trades below a bearish trend? It's because you don't have a solid understanding of market movement or price action, as the case may be. So that's the second reason. First reason is they overtrade. They're given to trading so much. Second one is they flip their bias too much or very quickly. Now, the third one is that after they have taken the wrong trades, and they have seen that price got to that region and stopped all of them out and went in the initial direction, like so, the initial direction, which is downwards. By the time price actually gave me that entry signal, like a break of the counter trend line and that minor zone, a lot of traders are not even interested in the trade anymore because they have been stopped out. The market has taken their money. Most of them, their accounts are red already at that point, and they will miss out on the trade. So this is not a missed opportunity. So this is just an example of why traders miss trades like this. And it's pretty common because all this ties back to discipline. All this ties back to how to actually manage your trading plan as a trader. So in addition to overtrading, as to why a lot of traders miss trades or miss out on trading opportunities, another reason why most traders miss out on trading opportunities is lack of journaling actually. So once you don't journal your trades, how then will you know that this setup is repeatable and is likely to reoccur? Now, once it does reoccur, how well can you spot it that this is a valid trading opportunity that you have traded before? How will you be able to do that once you're not journaling your trades? Point of note. Another reason why traders miss out on trading opportunities is because they have had their charts blocked out with a lot of indicators, overly customized indicators, and these indicators tend to block out or filter out naked price action, which is very, very important for you to spot as a trader to be able to take pure trading opportunities. So how do you never miss trading setups like this again? The first thing is to create a playbook. And in this playbook, let's say the playbook has about 3 to 5 setups, which you drill daily. If you're a day trader, you know that these are the setups you only want to be taking, 3 to 5 of them, with number 1 being your A plus and maybe number 5 being your, I don't know, C setup, which if you ask me my opinion, you shouldn't be taking a C setup. But you get the gist of what I mean. And any other thing, any trading opportunity or any strategy outside of this spectrum of your A to E, whatever the case may be, do not take them. That's one. The next one is recognition equals repetition. So if you're able to recognize that this trade has played out before, what stops you from taking it again when it does show up? The only thing that is going to stop you from taking it again is if you cannot recognize it on the spot, because it's going to take different forms. Do not expect the market to give you the same pictorial representation of your setup as was seen in the previous trade. It's going to give you something else based on the market perspective at that time. And price action, I'm going to tell you guys, is a combination of human psychology. So this is different trading psychology being printed on the charts. And don't expect them to be the same because humans are difficult to analyze or control. So if you are waiting for the perfect trading setup as it was given to you previous time, think differently this time around because you're not going to get it. So for you to be able to recognize that this pattern has played out or something similar to this pattern has played out before, you need to have a visual representation of it in your mind. And the only way to do that is to journal your trades, like I said so earlier on. The best way to journal your trades, guys, is to take a screenshot. Take a screenshot before that trading setup. Take a screenshot whilst you took the trade once your entry criteria have been met, and take a screenshot after the trading setup. Whether you got a win or a loss from that trade, you still take a screenshot of it. Now, what this is going to do is going to give you a vivid picture of it whenever you review your trades to know that these are the kind of setups that I should be expecting. It presented in this way, so I took this trade. Peradventure, it does this in the next trade, but in a different way, still within the parameters of my trade. Still within the representation of this trade. I'm going to take it. So that's where a trading journal comes in. And the best way to do that is to have screenshots. I've said this countless times. I've said it again. Learn it. Set alerts as zones instead of staring at charts. You don't need to stare at your charts all the time. Even if you're a day trader, you still don't need to stare at the charts all the time. You should actually learn to use tools to your favor that will make you reduce your screen time. Well, there is a vast rift between day trading and swing trading. That I know for sure. If you're a day trader, because of the nature of trade entries between the two, it's very common to see day traders being stuck to their screen most times than swing traders. Swing traders have a lot to do. I mean, being given to swing trading gives you a lot of leverage, I must say. It also gives you a lot of freedom. You just set your charts and go and do other things. And let price action and let your price alerts, which I've set, help you do the heavy lifting. Software like TradingView helps you set alerts on your trades. So if you get a TradingView account and have a paid plan, you can actually be able to set alerts on your setups whenever they emerge. You're going to get an alert or a notification whatsoever in your email or your phone number, however you set it up to be, and you go and do whatever you want until your trade alerts have been kicked in or triggered. That's the best way to go about trading. And if you're interested in trading with TradingView, there is a link in my bio. Grab your TradingView account and start trading. So now you know why most traders miss the clearest setups. It's not a strategy, it's the awareness. If this video helped you, you will love the deep dive that I did on the 5 differences between demo trading and live trading. I'll link it right here. And if you want to train your eyes to spot setups faster, I've created a free checklist you can download below. It's the one I use most times before taking a trade. Smash that like button if this opened your eyes to something new. And subscribe if you want more content that cuts through the noise and makes you a better trader fast. I'm Kojaks Pro. See you in the next one.